What if I told you I could turn $1 into $23? And on a larger scale, that's $10,000 into $230,000. That's right, 23 times your initial investment. More importantly, I'm going to talk about what compound interest is. So if you're interested in interest, stick around. My name's Zach and welcome back to my channel, Another Aussie Investor. Now you might be thinking, what am I talking about? Well, we'll get to that in a second, but first we need to understand compound interest. Compound or compounding interest is the interest that is earned on the initial principal, but it also includes all the accumulated interest on the previous periods of the deposit. So simply put, it's almost like interest on interest. So this sum is going to build over time and become larger. With this method, it's not about timing the market, but more about time in the market. And time's going to be your friend on this one, so the sooner you start, the better. As we know, the standard rate of return on the stock market is 7%. So if you were to take $1 over 45 years at 7%, you end up with $23. I know this doesn't seem like a lot of money, but let's have a look at that on a bit of a bigger scale. So let's look at something in the short term. If you take $1,000 and in 12 months you get a 7% return after inflation, all of a sudden you've got $1,072. I know this doesn't seem like a lot, but then we take that $72 in interest that you've earned and reinvest it for another year at 7%, and you've made $77 on top of that, bringing your total to $1,149. Over time, this method earns more and more after each year. So after 30 years, your initial investment of $1,000 is now worth $8,116, meaning you've earned a total of $7,116 in interest after we calculate for inflation. Now this next part is where things get exciting. Let's take the numbers up a bit and have another look. Let's say we've got someone who's 20 years old. Perhaps they run into some inheritance, maybe downgrade their car, or they've been saving some money and they're not sure what to do with it. Let's make this number say $10,000. We put that into a tracked ASX 200 index or ETF, which data and studies have shown will get that average of 7% return in the long term. In just 10 years time, when they're 30, that investment would have doubled to $20,000. That's right, imagine just putting money in and forgetting about it. 10 years later, you've made an extra $10,000 by not doing a single bit of work. That technique is called passive investing. By the time they're 40, that money would be worth $40,000. But here's where things get interesting. If they can hold out until they're 60 years old from that initial one-off investment of $10,000 with an average of 7% return, that money would be worth a staggering $163,000 from the compounding interest. That'd be a nice little touch on top of your retirement. Now I understand, of course, not everybody has $10,000 laying around. So let's have a look at one last example. If you can find a way to put $200 a month into an investment based on that same 7% return, you take the dividend and anything else you make and reinvest it back into that. Over time, this is going to become a phenomenal amount of money. Let's have a closer look. After a year, you would have invested a total principal of $2,400 and earned $79 worth of interest. I know that's not a lot of money for putting away $200 a month, but you'll see. Let's have a look at what happens 5 years from that first date. By now, you've deposited $12,000, earning you $2,319 in interest, bringing you to a total of $14,319. Again, I know this isn't a huge amount of money for that time frame, but remember I said that time is going to be your friend on this one. Let's look a little deeper. So if we jump to 10 years after that initial investment date, all of a sudden you've put away $24,000 in the form of regular deposits. you've earned a return on investment of $10,617, bringing you to a total of $34,617. So as you can see, the difference between the 5-year period and the 10-year period has already made a large difference. Let's push this to a lengthier time period. Let's say 35 years from the initial investment. With just $200 a month, your regular deposits total an amount of $84,000, but your interest has earned over $276,000. Yes, that's right. That brings your total to $360,000. With consistency and hard work of putting away just $2,400 a year, you can have the potential to earn yourself a rather large sum of money over time. Now I'm going to leave a link below in the comments to a compound interest calculator so you can play with some of your own numbers due to your own budget and figure out what you could do. But I just want to show you one last example if we really push this to the extreme. Let's say you cut back on a few extra things in life and you find a way to put away $500 a month. In 40 years' time, you would have deposited $240,000 and earned over $1 million in interest, bringing you to a total of $1.3 million. All of this just through a passive income strategy. If you took the time to learn more about the market, you could earn even larger amounts of return. Let's be conservative and say you study the market and you find a way to make 9% returns on average instead of 7%. We run those same numbers over the same time period, that would total over $2.3 million. Now, of course, it's important to do your own research on stocks and companies before making any decisions, but you can see the results of compound interest really is something quite amazing. Einstein even went as far as to say that it was the 8th wonder of the world. If you've learnt anything from this video, guys, please do like, subscribe, comment and share, and we'll see you in the next one. Thank you.